All right, here we are again. So let's get to it. And this is the 5th week of our class. And I'm going to go find our notes. Yes, here we are. All right, so this section is entitled Properties of Stock Options. And so we're going to be looking at several important concepts with regard to options. In particular, the factors that determine the value of an option. We're going to look at some theoretical discussion about how or the range of possible prices an option can have. We're going to be introduced to a very important concept called arbitrage. And we'll be looking at put call parity. Okay, now some of these we may have touched on before, but we'll be looking at them in a little bit more detail tonight. So we'll start by noting that the factors that ultimately determine the price of a stock option are, of course, the asset price or stock price itself, the strike price of the option, the time until the maturity date of the option, the volatility of the stock's price, the risk-free rate of interest, and finally, the present value of any expected dividends that we think will be paid during the lifetime of the option, if there are any. Okay, all of these factors will have a direct impact on the price of the option, and what we want to understand is how and why this is happening. So we start now. I put together a helpful little table here, and so because it's a lot to remember, but I think you'll agree that most of these are just really kind of common sense, keeping in mind that a call benefits when the price of the stock goes up, and a put is harmed by that. So in the first row, you can see if the stock price goes up or down. If the stock price goes up, a European call should gain in value, a European put should go down in value, and the same thing will have to be true for an American call or put. Anytime the asset or stock price in this case goes up, the call becomes more valuable and the put becomes less valuable. And then, of course, these are exactly the opposite. If the strike goes up, that's going to have a detrimental effect on the call because it's harder for the option to move into the money. And that will be helpful to a put. So in other words, with a put, the higher the strike, the more valuable the put will be. And that won't really change when it comes to American calls or puts. Now, here's a strange one. Normally, more time means that the option is more valuable, but there can be some very strange cases with European style options where the time doesn't always help the value of the option. And so we'll see a couple of those oddball cases, but the majority of the time, the European call and put behave exactly the same way as the American call or put, which means that the longer the maturity of the option, the higher should be its value because that gives us more time for the option to move deeper into the money. Now, here's an interesting one, volatility. You might not realize this, but volatility is actually very good for an option. The more volatility we have with our underlying security, the more valuable the option will be. And really what this comes down to is the idea that there's a limit to how much we can lose and no limit to how much we can gain. So therefore, if the volatility rises, it adds probability to having an enormous payoff. It also adds increases the probability of having a very poor outcome. But remember, once the option moves out of the money, from that point on, no matter how far the stock price falls, the option's value is essentially zero. So on the downside, once we move into the out of the money, rather, the more deeply we move out of the money, that has no real bearing on the value of the option. But on the upside, the more deeply we move into the money, that adds more and more value to the option. So the gains from the upside are far greater than the losses on the downside when we have a more volatile stock. So volatility is the best thing in the world for an option. More volatility is exactly what we hope to see. Now, the interest rates, and this is something we'll look at later on, but interest rates affect calls in the same way. Higher interest rates are actually helpful to a call, and lower interest rates are actually helpful to a put, and we'll see why in a bit. And then finally, dividends. Now, here's the interesting thing about dividends. When a stock pays a dividend, the price always goes down in the market by the same amount as the dividend. So let's say Apple decides to announce tomorrow that they're paying a $2 dividend. What you would expect to see is the Apple price go down by $2. And actually because of arbitrage considerations. So that being the case, if the dividend is going to cause the stock price to drop, that clearly will be harmful to the call and helpful to the put, whether it's American or European. It doesn't make any difference. So in other words, because the dividend forces the stock price down, at least temporarily, that's going to be harmful to a call and helpful to a put. So this chart summarizes them. Now we'd like to maybe go through them in a little more detail. And so for example, I think it should be pretty clear that with the stock price, since the higher it goes, the higher the payoff will be to a call. Therefore, the call price goes up and therefore the put price goes down. So you might recall, for example, the payoffs. Let's write them back down here again, just as a quick reminder. Now, clearly, since X is a constant, if S goes up, the payoff has to go up. In fact, if S rises by $1, the payoff goes up by $1, as long as it's already in the money. Okay, when it's out of the money, we have to wait for the stock price to hit X before this relationship is true. So, but in general, the higher S is, the higher will be the payoff. And of course, the put payoff is the opposite. The put payoff, we're hoping for the stock price to fall because the payoff is structured as max X minus S in 0. And so that means if S goes up, then the payoff goes down because we're subtracting S rather than adding it. So the stock price goes in the same direction as the call price and in the opposite direction of the put price. Nice. Now the strike, as of course, as you know, it just is exactly the opposite of what we just said, because again, if the call payoff is max S minus X in 0. Now the strike price itself doesn't actually change. What this means is that if I buy an option, which is the same, but with a higher strike price, if it's a call, the price will be lower. Okay, so in other words, high strike calls are less expensive than low strike calls, because the stocks, the calls with a low strike are more deeply in the money than the ones with the high strikes. So you can look at the pattern. In fact, if you look at, let's go back to finance.yahoo.com and make sure this is really happening. Let's look at some real data. That should be fun. All right. Let's just quickly find Apple stock options. And down here, you'll notice they have option prices. So we'll look at the top where the calls are. And if you look carefully at these prices, here's the strikes. As they go up, the prices, let's look at the higher the two is the one that you will pay as the investor. So in other words, you notice how if the strike is 65, the price is 67.90. But if the strike goes up to 80, like it does on the second option, wow, the price goes all the way down to 52.90. And as you can see, as I keep raising the strike price, the price of the call drops and drops and drops. And eventually it'll reach a point where it's essentially worth nothing. Okay, in other words, if the strike goes all the way up to $175, then the option is essentially worth a penny. All right. Now, clearly, the opposite is true with the puts. At the very low strikes, the price starts at a penny, and it just keeps going up and up and up. And gradually, it starts to rise fairly quickly. And way down here at a strike of 175, the corresponding put would cost about $42.75. 95 rather. Okay, so in other words, we can see for ourselves this inverse relationship between the call price and the strike, and the direct relationship between the put price and the stock. So remember, the put payoff is the max of X minus S and 0. So high strike puts are more expensive than low strike puts. All right, so that I think is just pretty much exactly what you would expect. All right, time to expiration. Now, again, like I said before, normally for almost every case, except one or two strange exceptions, for sure for American calls or puts, the longer the time to maturity, the more valuable will be the option. This is because the owner has more opportunities to exercise the option when it has a longer maturity, but also there's more time for the stock price to go up. All right, so if you have an option that expires tomorrow, well, it can only go up so much in one day. But if the option expires in a year, well, that means there's plenty of time for the stock price to go up. So investors would certainly prefer to have the 1 year option than the 1 day option, especially if they can exercise it whenever they want to. So this is very important for American calls or puts. In fact, why don't we go back to our information here. Now, if you notice, all of these options that I just showed you all have the same maturity date, which is May 7th, just a few days from now. Why don't we do this? Let's take a look at, let's try this 132 strike call. If you see, currently it's selling for $1.58. Why don't we take a look at the equivalent price for a 132 strike call that matures, let's say, not at the end of this week, but let's say, I don't know, at the end of the summer. Now, the only unfortunate thing about this is that there may not be a price available for that one because it is quite a bit into the future. But if you look carefully, oh, see, they don't even have that strike anymore. But look at this. The 130 strike is selling for $9.10. So that is a very significant increase, even though it's not the exact same strike. You can see that as we keep looking further into the future, the calls will become more valuable and so will the puts. And again, it's just because there's more time for the price to move in the right direction. And if it's an American call, that's simple, or put, that means we have more opportunities to exercise the option. And that, of course, is a premium or something people are willing to pay for. Now, the European option, since we have to wait to the maturity date, there can be situations where it is actually harming the option that we have to wait for the exercise. Usually what happens here is that this is only true. Let's say for a European option that is deeply in the money, the remaining time value is likely to be less than the earnings that would be possible if we could exercise the option and invest the proceeds into a treasury bill or a bank account. Now, we haven't really talked about time value in such great detail, but I think that's going to come up in this chapter. Let me just jump ahead a little bit and see if we're way down here. All right. So why don't we take a quick look at this graph while we're talking about time value. So this is a call. And what you can see here is that the red line represents the payoff to the call. It's flat. It has a payoff of 0 all the way up to the strike price. And then after that, the payoff increases on a 1-for-1 basis with the stock price. Fine. Now, the market price, though, is typically higher than for the payoff. And the difference between the two is known as the option's time value. The time value tells me how much premium I'm paying for this option to account for the possibility that as time elapses, the option could become more valuable. All right, now for very long-lived options, the time value can be very considerable, and for short maturity options, it can be very trivial. So once again, why don't we visit our chart here? And what I'd like you to notice here is that if we look at the options, let's try this. Let's go back to this group, the group that's going to expire on Friday, and let's pick a strike like 130. And if you look at the price of this option, compared to today's actual price of the stock, which is about 132.54, well, you would figure the price of the option is going to be at least 254. In other words, if I could exercise this option right now, I would have a payoff of $2.54 because that's the difference between the stock price and the strike price. But if you notice, the market price is actually $2.97. So instead of being 254, it's actually 297, which means that there's a discrepancy there of 43 cents. And what that's all about is that even though the option matures on the 7th, there's still a chance that the stock price could keep going up and I can continue to make more money. So that 43 cents represents a premium that I'm willing to pay in order to hang on to this option until the maturity date with a chance of earning even more money. So that's what this graph is meant to show us. The vertical distance between the payoff and this black line, which is the market price, is my time value. All right, that's what we call time value. And so the bottom line here is with time value is that the longer the maturity of the option, the higher will be the time value. Now, having said that, if you're looking at a put, especially a European put, this is where this can become an issue. What you'll notice is that if the stock is really, really small, let's say it's getting really way down here. If you notice very carefully, the black line, remember, is the market price. The red line is the payoff. Down here, the option's so deeply in the money that there's realistically no chance of it moving out of the money. So imagine the following situation. Suppose that the option is $100 in the money. Okay, and we could earn the risk-free rate is, I don't know, 3 cents, 3%. Now, over a week, that's not a lot of interest. How much could we earn? Suppose that this was a European put, an American put, and I could exercise it right now and put it in the bank for the rest of the week. Okay, so let's say that the maturity date is in 1 week. Okay, so the interest that I could earn by exercising now is, all right, let me quickly figure this out. It's not going to be a lot. It's about 5.77 cents. Okay, but suppose that the time value is only 3 cents, which is possible because there's only a week to go. Wouldn't you be better off then? Now, keep in mind, one thing I do want to mention here, when you exercise an option prior to maturity, you lose the time value. You only collect the payoff. So when you exercise an American option prior to maturity, you're weighing the gain of the premium, or actually the payoff itself relative to the remaining time value that the option has. So if I could exercise this right now, I certainly would, because I could earn 5.77 cents worth of interest compared to the time value of 3 cents that I would have to give up by exercising the option. That means I would much rather exercise now than have to wait. But because it's a European put, having to wait is actually putting me at a huge disadvantage. And so what that implies then is that the time value is actually negative. In fact, here it's negative 2.77 cents. So in other words, in a case like this, it would be better for if the option expired tomorrow rather than a week later. In other words, the more time that goes by that I have to wait to exercise this option, the worse off I am. So you actually have a brief range here with negative time value. And so that doesn't happen with American options. If this was happening with an American option, you'd exercise it early and you would collect your 5.77 cents worth of interest. You'd sacrifice your 3 cents worth of time value, and you'd be better off than waiting until the maturity date. Whereas the European holder does not have this option. And so only in these very extreme cases, though, do you find that the time value can actually be negative. And so because of that, that's why in this chart we have question marks in this chart for time. Let's go back here real fast. Question marks, where are we? It's so far back. Here it is. Question marks for European calls and puts, but not for American calls and puts. For them, more time is always good news. Nice. All right. Now, what about the volatility? What's that all about? Actually, you know what I wanted to do? I think I can draw a picture which shows why this is. So what we have to do is visualize that the price of the stock is following, let's say, the normal distribution. So let's see what I can do here. Here's the payoff profile. I'll make that red. This is the call payoff. Now, if you have a stock that's has very little volatility, let's say the returns are described by this curve. All right, that was supposed to be a normal curve. Let me try that again. You've all seen the normal distribution. It's a bell-shaped curve. So, with something like this, there's a decent chance of getting a pretty decent payoff. And then all of this, of course, means that you end up with nothing. Okay. So on the right, you have a positive payoff. On the left, you have a negative payoff. So let's say that I replace that with a different curve, which is much more volatile, meaning it's much more spread out. Okay, so the green distribution, this is high volatility. Compared to the black one with low volatility, I've increased the chances of finishing above X and below X by having much more volatility. But If I finish above X, that's adding a lot more money to my pocket. If I finish below X, that's still just zero. Remember, the payoff down there is just zero. So there's an imbalance between gains and losses when I have high volatility. Okay, so the high volatility, there's a higher chance of a huge payoff combined with a higher chance of a zero payoff. So you see how this works to our benefit. There's a very high chance, a much higher chance of getting an enormous payoff compared to adding a higher probability of getting a zero payoff. So on balance, we're better off with a high volatility stock than the low volatility stock. Okay, so I hope that helps make sense. I mean, why would volatility be helpful to options? Because of the asymmetry between gains and losses. We're adding more likelihood of the stock price falling dramatically, but once we get past X, it doesn't really matter. The payoff is zero. But on the upside, the payoff just continues to grow. So we're adding a higher chance of getting a huge payoff, while we're also gaining a higher chance of getting a zero payoff. So on balance, we're better off with the high vol stock than the low vol stock. And that's true for calls and puts. I just happen to pick the graph for a call. It applies to both, and it doesn't matter if it's American or European. This is always going to be true. In fact, volatility is really one of the primary drivers of the options volatility. And let's just think of a ridiculously simple case. What if we had a stock that has no volatility, which means it always stays at the same price, and that price is below X? Well, that option has zero value to us because there's no possibility of the option finishing in the money. All right, so that's why. So volatility is always helpful to both styles of options. Now, what about the risk-free rate? What does this have to do with anything? All right, well, this comes down to, think about this. All right, let's think about this for a second. What exactly is going on when you buy a call or a put? So, all right, imagine the following situation. Suppose that an investor can either buy gold. Oh, all right, let's put it this way. An investor needs to buy gold in 6 months in order to hedge his risk. He can buy the gold today, buy a call option on the gold today. Now, what would be the biggest advantage of buying the option instead of buying the gold today? Well, even though we have to pay a premium, or the investor has to pay a premium for the option, he or she also saves the interest that is required to finance a position in gold for 6 months. So in other words, by buying the gold now, you're tying up your funds for 6 months. So you're running into what would be called an opportunity cost. That's money that could have been used for some other purpose. And so you're giving that up when you buy the gold now, even though you're getting rid of your foreign exchange risk. Your price risk for the gold. You're still tying up your funds. So if that's the case, this means that buying a call saves on interest costs. Therefore, the higher is the rate of interest, the greater will be the savings, and the more valuable will be the option. All right, so now on the other hand, so in other words, remember what a call is doing. It means that we can hedge our risk without having to buy the asset today. And that's going to save us interest costs or financing costs. So the higher the rate of interest is, that means the more valuable the option really is to us. On the other hand, with a put, what's happening with a put? Suppose that an investor will need to sell gold in 6 months. All right, so the investor can avoid price risk, or let's put it this way, in order to hedge the risk, the investor can sell gold today and invest the proceeds. Or number two, buy a put. Okay. Now, that's assuming you already have the gold. That's part of the problem there. Now, so the way to think about this is having a put or owning a put means postponing the opportunity to sell gold and earn interest. All right, so in other words, if you buy the put, you're giving up the opportunity to sell the gold and invest the proceeds. So therefore, you're giving up the chance to earn interest. Therefore, the higher is the rate of interest, the greater is the sacrifice incurred by buying a put instead of selling the gold. So therefore, in a nutshell, what this means then is that higher interest rates increase the advantage of buying a call instead of buying the underlying asset, which increases the value of a call. Higher interest rates increase the disadvantage of buying a put instead of selling the asset, which reduces the value of the put. Okay, so therefore, I hope that analogy works, because now you can see why higher rates are helpful to a call, but harmful to a put. And this again is true whether or not we have an American or European style call. All right, so let's go back to the chart for a second, and you'll note that interest rates help a call and they hurt a put. All right. And then finally, the dividend. Well, the dividend, as I said, the price of a stock immediately declines after the issuance of a dividend by the same amount, by the way. If we have a $2 dividend, that means that the stock price will go down by $2. Therefore, like we know already, anything that reduces the price of our asset will reduce the value of a call, but help the value of the put. Okay, so let's go back and double check our chart. This is true again for both American and European options. Now, you're probably wondering, why is this happening? What kind of arbitrage would take place if the price of the stock doesn't fall by the full $2? All right, well, here's what would happen. Suppose that, for example, and by the way, with stocks, the day in which the dividend is declared, whoever owns the stock gets the dividend. So let's just say that this is today, and this is 6 months from now. And let's say dividend declared of $2, and the stock price is initially at $100. So this means that that day, the issuer of the stock says, we're going to pay a $2 dividend. And you'll probably get the dividend, let's say, the next day. All right, maybe not that day, but the next day. So here's the thing. If the stock price falls to only $99, investors could buy the stock for $99, collect the dividend, and let's see, how does this work again? The price falls to 99. No, sorry, this is the wrong one. Let's just say the price falls to 97. All right, let's say it falls too far. I've got it backwards. Sorry about that. Let's see, hold on. No, sorry, hold on. This is very confusing the way, let's just try that again. Let's just say right now it's today. It's the day before the ex-dividend date. All right, let's assume that. Let's get rid of this part. All right, so it's one day before the ex-dividend date. So here's what we could do. So in the first scenario, the price falls to 99. All right, let's keep it like that. Investors let's see, short sell the stock No, you know what? I think this assumes that you already own the stock. Okay, otherwise this is not going to work. Let's try it this way. Suppose the investor already owns the stock. It's worth $100. Let's put it that way. You own a $100 stock. All right. If the price falls to 99, we would collect the dividend of $2 and sell the stock for 99 for a total of 101. If the price falls too far, oh no, okay, no. The way it works is that if the price falls to 98, so this would lead you with a profit of $1. All right. If the price falls to $2, the proper amount, then the investor could collect the $2 dividend and sell the stock for 98. Which means there's no profit. Okay, so in other words, the price dropping to 98 simply means that if we collect the $2 dividend and we sell the stock for the new lower price of 98, we'll just end up with $100, which is what we started out with. Whereas if the price only dropped to 99, we could collect the dividend and then sell it to somebody else for 99, and we'd end up with $101, which is $1 more than we had before. So that would mean that we'd have a profit. And so everybody in the market would do the same thing. And so, and earn profits along the way. So in an efficient market, the price will drop by exactly the size of the dividend so that nothing changes with the value of the stock. So yeah, that's just sort of a detail on the side. Why does the stock price drop? This is the reason why. So it's going down, and so therefore the payment of dividends is going to be helpful to puts, but not to calls. All right, now, can we establish, before we actually introduce a formal option pricing model, which we will very soon, I don't remember if it's tonight or next week, but an actual mathematical model that will help us price options, we have to understand several key details about how they're priced and what limits are there on the value that they can attain. And so we'll start by introducing what we call upper and lower bounds for option prices. These are theoretical upper and lower limits for the prices of stock options that can be determined through the principle of no arbitrage. Now, arbitrage means that you have a scenario where you have one underpriced asset and one overpriced asset. So just in general, let me just throw this in here. An arbitrage takes place when it becomes possible to buy an underpriced asset, sell an overpriced asset without taking any risks. And even more importantly, using borrowed money. Okay, that's a key detail. You're not only not risking your own, you're not taking any risk at all, and you're not even using your own money. Okay, that's what an arbitrage is. It's something that you would never expect to see in an efficient market. And in fact, a lot of option pricing theory is based on the idea that the prices that we obtain are those that are consistent with no arbitrage. In other words, if these relationships that we're about to establish are violated, investors could earn no arbitrage profits. And by doing so, they would push the prices back to their correct levels. Okay. So yeah, now we can carry on with arbitrage. Now, here's the here's the main logic behind arbitrage. If we have two assets of any kind that have identical payoffs and equal levels of risk, they must sell for the same price in the marketplace. Otherwise, we can earn risk-free profits by taking a short position in the overpriced asset, meaning selling it, and taking a long position, which means buying it for the underpriced asset. Okay, but this requires our two assets to have identical payoffs in the future, and they must have the same level of risk. Otherwise, we're comparing apples and oranges. And if so, and we find a discrepancy in their prices, we can easily earn a risk-free or arbitrage profit by taking a short position in the overpriced asset, meaning selling it, and taking a long position in the underpriced asset, which means that we're buying it. We put the difference in our pockets and we have no future exposure whatsoever, which means that it's a risk-free position. Okay, that's a sweet position to be in. So we have a positive cash flow today with no cash outflows in the future because the two positions exactly offset each other. So again, option pricing theory, as we'll see, is heavily dependent on this notion of no arbitrage. And in fact, we can use this principle to derive upper and lower limits or bounds for option prices, within which our models obviously must be consistent. So for example, let's take a look at a call option. What is the highest price it could possibly sell for in the marketplace? All right. Now, by the way, in here, what we want to do is introduce the following notation. Lowercase c means a European option, call option, I mean, and then uppercase C is the American version. I know it's hard to see the difference sometimes, but we'll have to be careful here. The lowercase c is the European call. The uppercase C is the American call. So clearly, we know that an American call is worth more than a European call. So at the very least, we can say that the European call is is less than or equal to the American call, which in turn, as we'll prove in a minute, is less than or equal to the actual stock price. And so that simply means that the options, these call options, can never sell for a higher price than the underlying stock or asset. In other words, it could never be worth more. Let's say that you've got an option on Apple. The option to buy Apple stock can never be worth more than the actual stock itself. So that's just common sense, but you can prove it in a very interesting way by showing what the cash flows are of these assets. And you can demonstrate that if this was allowed to happen, then you would have yourselves an arbitrage opportunity. So what happens in this case if this, in fact, what if the call price does in fact exceed the stock price? Okay, for some bizarre reason, this call price is seriously too high, then we know that the call is overpriced and the stock is underpriced. And based on the principles of arbitrage, that means we're going to sell the call or write it. It means the same thing. And then we're going to buy the stock. And so we can prove that that will generate risk-free profits for us. But again, the logic is always you buy what seems to be too cheap or underpriced, and you sell what seems to be too expensive or overpriced. This means that we get a positive cash flow today, and in the future, we do not have any cash flows at all. So that's how we know that there's no risk. And if you look at it carefully, we didn't use any of our own money, because when you write the call, you get a premium, and then you use that premium to buy the stock. And in fact, when you collect your premium, it's more than enough to buy the stock. And so the difference between the two is your profit. So your arbitrage profit is in fact C minus S, which is greater than zero by assumption. Okay. Now, in these cases, what we need to do is keep track of what happens if we exercise or do not exercise the call. So in other words, remember what we've done here. We've written the call and we bought the stock. Okay, so the value of our position is we own the stock, but we shorted the call. Okay, or you can think of it as now, if the option is exercised, that means that S is greater than X. Okay, so let's think of that as case number one. We'll have S minus X equals X, which is greater than zero. Okay, so if the option is exercised, that would only happen if the stock price is greater than the strike, which means that the value of our position is S minus X, or you could rewrite that algebraically as X, which we know is positive. In the second case, where we don't bother to exercise the option, we end up with S. So either way, no matter what happens, the stock price, we don't care. We're going to get a profit. It's that simple. And no money came out of our pocket. And so to the extent that markets are efficient, you would never expect to see the call price selling more for than the price of the underlying stock. In fact, if we want to prove this, let's go back to the put call parity. I mean, so what am I saying? Where are we? The finance.yahoo.com. It's still here somewhere, I think. Let's see how expensive those options actually get. All right, it's being stubborn with me right now. All right, let's wait. Oh, here it is. It was over here, but it's still being stubborn. It's not letting me. Yeah, this makes me nervous. It means that Google Chrome is about to crash. Let me try a different browser, I guess. No, the computer looks like it's really very upset with me. Now, this is very bad. This happens if you don't reboot your computer every so often. You're just asking for trouble like this. It's just absolutely not working. All right, you know what I'm going to have to do? Unfortunately, I think I'm going to have to reboot the computer. So I'll tell you what. Let me take care of that right now. Yeah, it looks really rough. Um, I'm going to reboot it, and then we'll get back in about a minute or so. It won't take that long, but it's pretty clear to me that Google's about to Chrome is about to crash. So let's take care of that. I'll be right back.